Inflation data may be interpreted more intensely due to what's going on in the Middle East, and the numbers are hitting the wires. Our May read on the Consumer Price Index comes in exactly as expected, up 0.5%. As of now, I don't see a revision in the rearview mirror to up 0.6, but up 0.5, of course, would be the lightest since it was up 0.3 in February. We came in light. Jan and Feb were 0.2 and 0.3 respectively. It heated up after that. Now, if we look at core on a month-over-month basis, we are less than expected. Up 0.2, we're expecting up 0.3, and that is half of the rearview mirror, which was up 0.4. That equals where we were in Feb and March. To find a smaller number, you're going all the way back 1 year, basically, to May of last year. Now, let's look at the year-over-year perspective. 4.2 is the year-over-year. We were talking about that on the show earlier, Becky. 4.2 expected. That's what we received. However, that's not necessarily good news. It matched expectations because in the rearview mirror was 3.8%. 4.2 would be the warmest since April of 23. Now, in my opinion, year-over-year core is probably the most important number, exactly as expected, 2.9. But once again, it's still hotter than last month's 2.8. 2.9 would be the warmest since 3% in September of last year. Quickly, the index that goes back to 1913 comes in at 335. Why do I mention that? Because it's another new all-time high. After 100 and X years, we are now continually almost on a month-over-month basis moving up on the index. And if you look at the core index, same scenario except for 336. This started in 57, once again a record. You know what? I think we need to also look at real average hourly earnings. Year over year, they came in minus 0.7. And the reason I'm looking at these, because last month we turned it negative at minus 0.3, first negative number since Feb of 23. Now this now becomes the most negative number also since Feb of 23, because that was minus 1.1. And if we look at year-over-year weekly average hourly earnings, same scenario. It turned negative last month at minus 0.2, first time since May of 23. Now it's even more negative at minus 0.4, which equals May of 23. To find a more negative number, you're in April of 23. So the inflation, of course, affecting average hourly earnings both on a weekly and hourly basis. We want to make sure that earnings keep up with inflation. We don't necessarily want them to be much faster. We don't necessarily want to embed inflation in the wage component. That certainly doesn't seem to be happening here. Interest rates, they were really bouncing around a bit. 10-year briefly traded down to 4.51. It's back to 4.53, which it was pre-number, and that's up 1 basis point. Back to you.